Today, a weaker credit impulse signals more home price falls ahead. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. And as it's the last day of the month, we've got the latest data from the Reserve Bank and from APRA relating to credit. The Reserve Bank credit aggregates summarises all of the credit-related activity across the economy, whereas APRA's data specifically focuses on the banks, or the ADIs, or Authorised Depository Institutions. And the data this month really has quite a stark story to tell. The headline news is that overall housing credit is up to a new record of $1.82 trillion, which is up 0.31% from last month. Within that, owner-occupied lending rose 0.32% to $1.22 trillion, and investment lending was flat. Personal credit fell 0.27%, or $0.4 billion, to $147.1 billion, and business lending rose to reach $963.7 billion. So investment lending made up 32.7% of all lending stock and continues to drift lower, whilst business lending drifted slightly higher and is now 32.9%, compared with 32.8% the previous month. Now, in fact, the annualised movements by category really shows further weakness, with lending for housing overall now down to a 4% annualised figure. Owner-occupied housing rose 5.7%, and investment housing rose over the last 12 months 0.7%. Now, the 4% number and the 5.7% number are both, of course, higher than wages growth. Personal credit fell 2.8% over the past year, whilst business lending rose 4.9% on an annualised basis. And all of these figures are on a seasonally adjusted basis. Now, that clearly shows that the so-called credit impulse, in other words, the rate of change of credit, is continuing to slow. And as you know, my hypothesis has always been that the rate of change of credit drives home prices. As the credit impulse slows, so home prices slow too. Total credit was 3.9%, and that's the lowest level of growth for many years. We're going to look at the portfolio from an ADI perspective. So this is the APRA data. And you can see there that the rate of growth is continuing to slow. So overall credit rose 0.2% last month. Owner-occupied lending was 0.35%, and lending for investment property was actually down 0.02%. So what we can conclude from this is that the bank's loan portfolios are growing more slowly than the overall market. Now, this can be illustrated by comparing the RBA and APRA data, warts and all, to show the non-bank sector is growing faster than the banks. Overall, they now have 7.5% of the market, which is up from the lows back in December 2016. So that rate of growth is quite important. And there's another way we can look at it. This is showing you the owner-occupied rate of growth for ADIs, banks. This shows you the rate of growth for investment loans. Now let's overlay the non-bank mortgage growth for the same period. And this is the owner-occupied change. It's grown 14% over the last 12 months, compared with a much lower rate for the main banks. And the same is also true for the investment sector. Non-banks grew 2.2% over the last 12 months. So this shows you that the overall rate of growth for the non-bank sector that don't hold deposits, that fund their loan book from securitization or from private investors, and are not so strongly regulated by APRA. The overall rate of growth for the non-banks, you can see, is more than double that of the banks overall. So I think this stores potential trouble ahead. And by the way, in the US, just before the global financial crisis, it was the non-bank sector that went wrong first. Now, the next thing we can do is to look at individual lending portfolios. So this again is using the APRA data. And we can look at both owner-occupied and investment loans. And we can compare the month-on-month movement. So you can see that Westpac grew their owner-occupied book reasonably strongly and just slightly grew their investment loan book, whereas CBA dropped slightly on the investment side. NAB dropped their investment portfolio quite significantly, whereas ANZ dropped both owner-occupied and investment loans. And then some of the smaller players also grew just a little. But the striking thing is that HSBC was actually a very strong lender in the month, as was Macquarie Bank and Members Equity, and even AMP Bank grew a little. So you can see differentially how the major players are struggling in this new environment. And Members Equity Bank lent more than the regionals as well, which I think is also significant, and that will have a significant impact on the regionals' margins and performance in the next reporting round. Now, that said, the overall market share of the majors hardly moves. CBA still has the largest footprint for owner-occupied loans. And on the investment side, Westpac leads the way. And you can see that ANZ and NAB are battling for third and fourth place. And then we have a lot of the smaller players beyond. So whilst there have been some little differential movements, the overall market shares are pretty much as they have been for some time. Now, one other way to look at this is to look at the month-on-month movement over the last 12 months, the sum of the monthly movements. And here you can see that it's Macquarie and HSBC who have grown their investment portfolios the most over the last few months. Now, the 10% dotted line there in the red reflects the old speed limit that was put in place by APRA and is now redundant. But I left it in there just to make the point that pretty much all of the market is now way, way below the 10%. And indeed, market growth, in case you missed it, is just slightly above zero over the last 12 months. And it's worth noting that the major banks, the big four banks, have all seen their overall share relatively slide over the last 12 months. Now, just to complete the picture, we can also look at the total ADI lending book, which stood at $1.68 trillion, with owner-occupied loans comprising $1.12 trillion and investment loans $557 billion. And overall, 33.2% of the portfolio is investment loans, and it continues to fall. So in conclusion, it's worth noting that firstly, the credit impulse is continuing to slow. Secondly, the rate of loan growth is still stronger than wages growth, so household debt is still continuing to grow, which is a concern, bearing in mind we already have 1 million households who are currently in mortgage stress, according to our research. And the third point, and really important one, is the non-bank sector is still growing significantly faster compared to the banks. And of course, the non-bank sector is significantly worse regulated, some would say poorly regulated, relative to the ADIs. And whilst APRA, in theory, has supervisory responsibility for the non-bank sector, our intelligence is they're doing very little in that regard so far. Now, There will be some more detailed reporting coming through in the next few months, which will give us perhaps better information with regard to the non-bank sector. But nevertheless, it's clear to me that the risks in the system are continuing to build. But the bottom line is this: with that easing credit momentum, the credit impulse, home prices are likely to continue to fall a whole lot further. And typically, there's a lag of 6 to 9 months between the credit impulse and home prices. So let's see what happens over the next few months. And this flies in the face of those who said that if the Reserve Bank cuts, then suddenly, magically, home prices will start to rise again. Or maybe APRA should cut their hurdle rate from above 7% to 6.75 or 6.8 or something like that. I don't think either of those are going to have a significant impact on home prices. Frankly, I think that further falls are absolutely baked in, and I don't see any way out of this over the next few months. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.